Very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coghlan. Looking forward to getting us ready for this week. There's quite a few different things going on, so we need to be really clued into the major drivers, what's going on, why markets are indecisive, and exactly how that's all working out. Let me just change this. That should be better now. No, it's not that one. I want this one. That's better. Just as folks are signing in, if you could just let me know you can see my screen and hear my voice okay, that would be great. Good to see you. Thank you very much for coming. Don't forget, any entries, exits that we talk about, all of this will be from an educational perspective. It's not a signal trading service. So without further ado, I want us to get stuck into what we're looking at. It's a funny week. We are now in the Fed's blackout period. So the blackout period is a period of Federal Reserve silence before the interest rate meeting. So let's just check that I'm showing the right screen. Yeah, you see here that the blackout period begins just ahead of the 13th to 14th rate meeting, and over the weekend we have now entered that blackout period with the last Fed communication from Friday. Now the Federal Reserve at the moment is essentially saying that it needs to keep hiking interest rates to control inflation, but it's now expected to do at a lower path of rates. So if we take a look at what's going on across the calendar, I need to bring us up to speed with what that means as the big picture, and then we'll start looking into the detail for the rest of the week. So before we get started, just look, some of the things we're looking at, what's going on with the US stocks, getting the big picture of the non-farm payrolls. Bank of Canada's meeting this week, that potentially could be big, particularly if we saw a very dovish reaction out of the Bank of Canada. That could support more CAD selling. We've got the RBA meeting this week, so let's look at expectations for that. Gold could be its time to shine and looks very attractive over the next sort of 2 to 3 months, as well as looking at the EURUSD. We'll have a quick look at platinum, and I'll show you that very strong seasonal pattern that's really quite marked. Okay, without further ado, let's get stuck in. Just check how we're doing. Yeah, that's great. Okay, very good. Don't forget, you can ask questions as we go along, put in the Q&A box or the chat box. So let's get into the big picture of where we're at. And the best way to look at that is to start by looking at stocks. Now, if you take a look at the US stock market, and let's just look at the S&P 500, you can see that we are testing this very, very large trend line going all the way back from January highs of this year. We've moved up testing that, and we're finding some resistance in that 4,100 region. So we're at a decisive turning point. Now, markets have been rallying higher into that resistance area on expectations that the Fed is going to be hiking interest rates more slowly. If you just take a look at short-term interest rate markets, what we'll see is that gradually over the last few weeks, the expectations for aggressive Fed hiking has faded. And you can see here that the expectation of 91% for a 50 basis point rate hike, that's what markets are expecting, a slower path ahead. And we can just see that generally the move has been lower over November into December for the expectations of a 50 basis point rate hike is now expected. The terminal rate is expected to be a little bit underneath that 5% region. So it's a slower stroke, lower path of interest rates that short-term interest rate markets are expecting. But the Fed themselves has said that they're going to slow down the path of hikes, but they may need to hike further. So there's a little bit of difference between what the Fed's saying and what short-term interest rate markets are saying. That's not that surprising, because sometimes there will naturally be a different interpretation of what the Fed is doing, but the Fed has told us they're going to be data dependent. Now, if we just take a look at the recent data that we've had over the last few days, I just want to show you what's been happening. If we look at that core PCE print, I was really focusing on this. the inflation data out of the US. The Fed's focusing on inflation, and you see that headline year on year came in at 5%, and the prior was revised higher at 5.2%, and the price index came at 6%, and the prior was revised higher at 6.3%. What does that tell you? Inflation is stickier. So that means that there were sort of potentially good reasons for the dollar to gain out of that. Now, it didn't particularly gain on the back of that print, but it showed you that inflation is a bit stickier. Yes, the month-on-month fall fell a little bit, but the prior for the year-on-year data was revised higher and price index were revised higher. So inflation is a bit higher. But look at the ISM manufacturing data. That inflationary print showed it was a bit lower, 43, below market's minimum expectations. In other words, manufacturers are paying lower prices for their goods and their raw materials. So as a result, that means less inflationary pressure, a bit of a contradiction from the PCE print. We also saw a slowdown in US manufacturing. And if you just take a look at that US ISM data here, you can see that that's the services data. Sorry, this is services data. I haven't got the, let me just see if I've got the manufacturing data up here. I may just have it. Let me have a quick look to see if I've got that to quickly pull up. I think I might have it. Let's have a look. Yeah, so there's the prices paid. That's tracking lower. That's a good sign. Inflationary pressure dropping for US manufacturers. New orders also falling. Okay, so falling new orders, falling inflation pressure, and you can see that the actual ISM employment data, drifting a little bit lower. So all of that meant that, okay, the Fed can be slower in hiking interest rates, and that should be supportive of dollar weakness. So a little bit of a contradictory report. Then we had the non-farm payrolls. Now, non-farm payrolls showed good jobs. Look, headline came in at 263 versus 200,000 expected, nearly above the high forecast, and the prior was revised higher to 284,000. And the worrying print for some investors was the average hourly earnings year on year. It came in at 5.1%, above the 4.6% expected, above the highest expectations of 4.7%, and the prior was revised higher. So in other words, workers are earning more per hour. And what that means is inflation started to get into wages. That's what some investors were fearing. So all of that translated in some dollar strength out of the non-farm payroll last week. And if we just take a look here at the dollar index, you can just see here the dollar surged on that non-farm payroll and then sold off, and we've got the dollar selling off now at the moment as investors are trying to work out, well, what direction is the Fed going to move in? Is the Fed going to be aggressively hiking interest rates, or is in order to contain surging inflation, or is the Fed going to be able to slow down the path of interest rates because US economic growth is slowing? So that's some of the key issues that we've got at the moment, and sentiment is quite mixed as we start the session. Chinese sentiment is good on more reopening news across China. Some further COVID restrictions have been loosened in Shenzhen and Beijing. That has been helpful for sentiment, and there's also been some good sentiment news today on the squawk that let me show you here. That China could be announcing 10 supplementary COVID measures and downgrading COVID to category B management as early as January. So China's starting to pivot away from their very strict and harsh COVID measures. All of that is positive sentiment. That has lifted Asia stocks. It lifted European and US stocks to start the session. That's now faded. It helped lift commodities like copper and oil are both supported, as well as the news about the Russian oil price cap that's been announced, that should be supportive for oil prices as Russia and their war fund is being being clipped by this Russian oil price cap. There's only so much that Russia can get for its oil exports. That, of course, is supporting oil prices higher, as particularly Russia threatened maybe reducing supply. So that's supportive for oil prices. Copper pushing higher on that positive China news, but sentiment's very mixed out there. Okay, gold finding support on its pivot area. And gold is worth looking at, particularly if we start to see yields drop lower. And look out for the manufacturing PMI print that's coming up in a bit. I'll show you what to look for that for gold. Bond yields pretty much flat, waiting for a few fresh catalysts. Dollar index, you can see the Dixie trying to push lower. Will it push lower? Technically, it's moved lower. So we need to see if there's more dollar weakness ahead. And if you just take a look at the major currency pairs, you can see that the dollar's pretty much flat on the session, waiting for a fresh catalyst, and dollar pairs are broadly supported with the weakness of the dollar that's just kind of there, but otherwise sort of flat trading and directionless moves. Gold is worth looking at medium term now. Do you see the way that you've got real yields and the dollar moving lower? If this keeps happening, if we keep getting real yields falling lower and the dollar falling lower, that is a strong catalyst for gold gains. If you look at this historically, look, when you have real yields and the dollar dropping, do you see how gold surges? Do you see that 2020 move? Real yields, dollar dropping, gold surging. What have we got at the moment? Real yields, the dollar dropping, gold starting to surge. So if these keep dropping, then expect gold to surge. And if real yields, if inflation, there's two stories to look for here. If inflation starts to peak, real yields should drop. And if US economic activity continues to shrink, then yields will fall, and that will push real yields lower. So if yields start falling and inflation starts falling, and particularly if yields fall quicker than inflation, then real yields will accelerate lower, the dollar's continuing to sell lower. So if you are long gold or looking at gold longs, as long as real yields and the dollar keeps moving lower, that's supportive for gold upside. My apologies, it's been a long introduction today, but we needed to get our heads around what's going on. Those are the main drivers. It's all about the Fed. It's all about the Fed policy on the 14th of December. It's all about how slow, how quickly the Fed is going to be. Now that we understand that, let's get into this week's data. So, what have we had so far? Well, so far, as we've gone through the session, we've had Chinese PMI and services data. That's been eclipsed by the COVID reopening news. Now, if those of you who've been following HYCM blog and me for a while know that we weren't surprised by that. As soon as China started to prioritize the vaccination program of the elderly, we saw that. I personally saw that as equivalent to a pivot. And we've seen a lot of China 50 stocks upside. Don't forget my blog.hycmlab.com. I go through a whole host of different details, and you can if you just go to my blog and put it in China, you'll see all the different posts that I've been doing over a while, just saying, bullish Brexit going on, why China's reopening argument is unhelpful, looking back, right back a month ago in November, just saying, look, this is the kind of area, will China find near-term support here? And the answer was yes, it really did, because, China was going to have to pivot away from the policy at some stage. So, it just seemed it wasn't surprising what they've done. Now, if you look at the German and UK PMI prints, this is purchasing manager indexes. So purchasing managers are asked questions like, do you expect to get more or less orders? Do you expect to employ more or less people? Do you expect business conditions to be better or worse in 6 months' time? Right? It's kind of their leading indicators, and they're all falling lower, and all of that's expected. None of this was a surprise. We know that the situation is difficult for Europe. We know Europe's heading into a recession. Is there anything tradable there? No. None of it's new. None of it's a surprise. If it was a bit better than expected, so what? Still pretty bleak with a war going on, Russia, Ukraine. You've got energy crisis, inflation, uncertainty about the ECB's policies. All of that's just negative for the euro. And the euro will remain being dollar driven at the moment. Remember, the euro US dollar is inversely correlated to the dollar. So if the dollar falls lower, euro US dollar gains. If euro US dollar gains, the dollar falls lower. So dollar driven eurozone. What is interesting though is these services PMI prints coming up later today. That is interesting, and that, in my opinion, is tradable, because remember, it flows into that narrative. What's the Fed going to do next? If the Fed sees slowing growth, slowing services, they're likely to raise interest rates more slowly. And if you look at the ISM print, which I should have, the services should have here, that's not the one. This is, where is it? That's not, I don't want that one. I want the services. Here it is. So do you see how the services PMIs have been dropping lower during this year? And expectations are that it's going to fall to the lowest since sort of May 2020. Okay, so expectations are that the service sector is starting to struggle in the US. Now, with the service sector starting to struggle in the US, that should mean the Federal Reserve are slower in hiking rates. So here's what I'm looking for. If this print comes in below 51.4, then that should increase expectations for a more dovish Fed. That should weaken the dollar. That should strengthen gold. I'm just pausing on stocks at the moment. It should support stocks, but I'm just cautious on this, okay? So a big miss here, I'd expect that to weaken the dollar, and so I'd expect upside in the euro US dollar. I'd expect downside in dollar yen, upside in gold. Okay, so big miss here, that would be supported. If there's a big beat here, if these services print comes in 55.2, I think that's also tradable. And again, I'd trade it by the dollar, and I'd look at short-term upside in the dollar index, or if you haven't got access to the dollar index, short-term euro US dollar shorts is what I'd look for, or dollar yen longs. So that is if this ISM data print. Best opportunity would be on a big miss for me. Best opportunity, big miss, I do quite like gold longs if we came in below 51.4, 3 o'clock UK time. That's tradable because it plays into that narrative. How quickly or how slow will the Fed hike interest rates? 6th of December, we've got the RBA rate decision. Now, remember what's expected for the RBA. Do check out my blog for a quick prep of what happened last time. You can see that interest rate expectations have been dropping for the RBA all the time. Terminal rate has fallen from a week ago. It's expected to be just under 3.5%. RBA currently at 2.85%, and they're expected to hike interest rates by 25 basis points today, right? That's the majority. So if they hike by 50 basis points, that would be a big surprise. You'd expect upside in the Aussie New Zealand dollar. If they don't hike at all, I'd expect downside in the Aussie New Zealand dollar. I trade it against the New Zealand dollar, and I want to see a surprise. And also look at the forward guidance. Are they more or less aggressive on the path of interest rates to come? If they're very dovish, then I would look at potentially Aussie New Zealand dollar selling. That would be my preferred currency pair to trade, and I'll be looking for a short-term shift lower. And if the RBA being very dovish overnight, Aussie New Zealand dollar selling from Tuesday's European session on retracements would make sense on any sort of pullbacks on that. ECB speaker, John, not expecting much from that. Then Wednesday, not expecting much from the GDP print. There could be a little bit of flow over from what happens to the RBA. Depends on what the RBA decision is. So just watch. If the RBA are very dovish and GDP is very dovish, then that would accelerate further Australian dollar weakness, particularly against the New Zealand dollar. ECB's Lane speaking. Lots of mixed drivers for the euro. I'm not interested in trading the euro on ECB speakers or European data right now because there's so many mixed drivers. Russian, Ukraine crisis, energy crisis, inflation crisis. It's just crisis after one crisis after the other. So very hard to pick a near-term direction. The best opportunity for the euro, in my view, would be if Russia and Ukraine make some kind of peace terms. That would be an instant euro US dollar buy. Okay, so peace in Europe, some kind of peace negotiation between Russia and Ukraine, the whole world will cheer. And from our perspective, from just purely a trading perspective, obviously from a personal perspective, wonderful news for all of us. From a trading perspective, that would really boost the euro. So not expecting much from Lane or McCall. The Bank of England interest rate decision, will be covering that on Wednesday. So do come drop by on Wednesday. I'll get us totally ready what to expect for that. Bottom line, what the last Bank of Canada interest rate decision, we were expecting the CAD to start weakening. If you remember that last CAD decision, we saw a lot of CAD strength up in this area. And the Bank of Canada have now basically said they expect the first half of 2023 to have a recession and to move back into contraction territory. So we're expecting CAD selling. We had quite a lot of selling now. Could there be another leg lower? I think there could be another leg lower in the Canadian dollar, but we would need to see a very bearish Bank of Canada. Probably short-term opportunities are going to be best, but I will cover that in more detail nearer the time. RBA speaker, remember to read that in line with what's happened already. It's not expecting a big move from that, but just to note it, if we do start to see all the Australian RBA interest rate decision plus the GDP data plus the speeches all moving the same direction, that will push us in clearly one direction. 8th of December, Bank of Canada Kazuki speech. We will cover the Canadian data and more ECB speakers. President Lagarde, that has the potential to move the euro. So worth being aware of Lagarde's speech, but I'm not expecting any fireworks from her this week. And then we've got the Michigan consumer sentiment print. Very important print, lets us know exactly how US consumers are feeling about the path of US inflation and the path of US economic activity. You see these inflation expectations, right? They're expected to fall to 4.8% from the prior of 4.9. That is potentially good news, okay? So that should potentially keep the dollar weakened into Friday, potentially. But if that inflation data comes in high, you know, above the prior reading and above 5%, then investors will worry that inflation is stickier in the US and there may need to be more aggressive interest rate hikes. Now, also look at the 5-year inflation expectations. That's expected to fall from 3 to 2.9%. If that ticks higher, that 5-year inflation expectations, that will really worry markets, because that will say that consumers think inflation is not a one-off, but it's here to stay. And if inflation gets stuck in an economy, the only way you can deal with it that really markets have shown as effective is by hiking interest rates aggressively. If interest rates are hiking aggressively, that means the cost of borrowing increases, and that means stocks will fall. So if we see a big beat in inflation expectations for the 1 year and the 5 year, if it comes in above 5% for the 1 year, above 3% for the 5 year, then, and if also we saw, like, if this was green, you know, but these two, the inflation expectations are red, that would be a scenario we'd expect stocks to fall very, very sharply. So just be conscious where we are technically, that we are right up at this technical level, right? So use this as a support and resistance levels. Get above and stay above, it's bullish. Okay, get below, stay below, it's bearish. So just to be aware of that dynamic that's going on. Tricky market conditions. Is it worth having a long-term view here? In my opinion, no. Trade the short-term bumps in data as investors either push towards an aggressive Fed or pull away from an aggressive Fed. It's all about what the Federal Reserve is going to do. And current expectations, just so we're clear, are that the Federal Reserve is going to hike interest rates by 50 basis points. But remember, if inflation is really high, then this will change. If inflation is really high, then expectations for a 75 basis point rate hike will start to increase, and that would necessarily strengthen the dollar. So just to be aware that inflation and US economic activity is the most important data in light of how it will impact what the Federal Reserve will do in terms of interest rates. Remember, when interest rates are high, that's generally worse for stocks. When interest rates are low, that's generally supportive for stocks. Borrowing costs are generally cheaper, and economics activity is generally stimulated because there's more free money in the economy, less money being paid out on mortgages, and more money to be paid and products and companies, etc., etc. So are these tricky market conditions? Yes, they are. Let me look at that platinum seasonal pattern for you. It's one seasonal pattern that's really worth being aware of because it's fantastic and one you don't want to miss. Let's just see, where is she? There she is. Right, so here's the pattern in platinum. If you just look at platinum over the last like 35 years, if you look from December, say like 24 through to February, you can see, look, and in fact, probably better if you do over 25 years, it's probably, you can see it. Look, in the last 25 years, platinum has gained 21 times during those 25 years. There's a specific reason for that, is purchase managers buy their platinum at the start of the year, and that tends to boost prices. So you can see, generally speaking, the average return is nearly 10% in platinum prices from like the end of December through to the end of February. So be very, very, cognizant of that. Very, very strong data point. Okay, folks, I hope that's been helpful, and I hope you're prepared for the week. But remember, my opinion, and of course this is just my opinion, short-term trading is best in these markets, looking for clear directions as the US economic data either pushes towards more aggressive interest rate hikes or away from it. Thank you very much. Don't forget, on Wednesday, due to be back here, and we'll get ready for that Bank of Canada interest rate decision. Thanks, everyone. As always, take care and have a great trading week. Thanks, everyone. Goodbye.